Welcome to Do You Know All Your Real Estate Investment Options. We'll be starting in just a couple of minutes. Welcome to Do You Know All Your Real Estate Investment Options? We'll be talking today about the growing opportunities crowdfunding is offering as a means to invest in real estate. I'm Suzanne Silverman, Editorial Director of Multi-Housing News and Commercial Property Executives, and I'm here with Adam Kaufman, Co-founder and Managing Director of Arbor Crowd, part of the Arbor family of companies, and David Dent, Senior Real Estate Market Analyst at Yarny Matrix. They'll be giving you both the big picture and some granular focus on crowdfunding and the current real estate investment environment. We're going to leave some time at the end to answer your questions, but please feel free to submit them at any time during the webinar. Adam, I'll hand the microphone over to you so you can start the conversation.
Suzanne, thank you. Thanks for having me today. I'm excited to talk about Arbor Crowd and the crowdfunding industry in general. Arbor Crowd is part of the Arbor family of companies, like Suzanne mentioned. Our affiliate Arbor Realty Trust, or our sister company, is a publicly traded real estate investment trust. We also have AMAC, Arbor Management Acquisitions Company, which is part of the Arbor family of companies and serves as the private equity shop. We formed Arbor Crowd in 2016 in January with the basic understanding that technology and legislation was bringing access to a whole new class of investors that could invest in the same real estate transactions that we were seeing and investing in previously entirely online, and really giving that retail investor that opportunity, the same opportunities that we're seeing. We also understood that our sponsors that were coming to us on the Arbor Realty Trust side for debt financing always needed passive, non-interfering equity. And having retail investors come in on the crowdfunded level really introduces a whole new class of equity and part of the capital stack to the market. I'll talk a little bit about Arbor Crowd a little bit later, because I'm really here to talk about the market and how that's changing. So like I said, the Arbor family of companies works together. Why is that important to know? Because Arbor Realty Trust, as the publicly traded REIT, has a depth of experience that has served over 20 years of leadership that extends into Arbor Crowd and our leadership team here. And what it really does is gives us the breadth and scope of access to quality deals in the market, deals and relationships that we've had and developed over the 20 years to, on the financing and debt side, to offer sources of equity. And that is an important thing that you don't really see in the crowdfunding market today. You don't see that depth of experience, and you very much don't see a family of companies participating in the capital stack, both on the debt and equity side. So we really feel that the interests are aligned, and we have a great product that we bring to market to this new class of investors to participate in. A lot of people don't actually know, but they think crowdfunding started with the passage of the Jobs Act in 2012. That's really what brought it to fruition through technology. But the first crowdfunding project was actually done in 1885 to create the base of the Statue of Liberty. And why am I telling you this? Because it's a really important concept that actually is the core foundation of what the crowdfunding market in commercial real estate serves as today. You had Joseph Pulitzer, who went to his newspaper, the New York World, and said, I need to raise $160,000 worth to build the base of the Statue of Liberty. Today that equates to $64 million. And all he was asking for was a minimum of $1. So why would people come and give $1 to participate in the base, which was a lot of money back then? Because of the concept that he said, if you give $1, your name will be inscribed on the base of the Statue of Liberty forever. That tangible ownership is what's driving the commercial real estate crowdfunding sector today. People want to participate and own something that they previously couldn't, and that excites people and that drives people. We've seen from 2014 to 2015 alone a 2.5 times multiple in the amount invested in commercial real estate crowdfunding today, from $1 billion to $2.5 billion. And we're currently expecting and forecasting that by 2025, there'll be $300 billion worth of commercial real estate crowdfunding money in the whole commercial real estate pie. Now, I know it's a small amount, but it's a very fast growing one. And that's what's really important to take notice of, because there are a lot of companies out there that are growing and, adopting the crowdfunding method. And with that global access from people being able to participate that from their computers, from their homes, from their offices, and tap into an entirely new investment, that is the future. And with the passage of the Jobs Act, you have the fintech industry emerge, which is really where crowdfunding plays into the entire space. It's a financial technology services company. So anything from online banking to online investing really falls into this fintech market. Now, even crowdfunding is really new. Essentially, it went into law to publicly solicit investors online in 2012 with the passage of the Jobs Act. What that's doing today is a lot of companies are coming to exist and trying to figure out how can we best do that? What's the best model? And the regulations have to yet catch up, and it's a trial and error thing. So it started with this 506C offering where you could go out and solicit accredited investors online to participate in commercial real estate transactions, all from the comfort of their home using technology. What this was, it was a direct-to-investment model. So people could actually see the deals that they were investing in, depending on the platform and how they presented those deals, and make that investment if they were accredited. What quickly happened was the Reg A Plus model that was introduced in 2015, March of 2015, and a lot of companies quickly jumped to that model because it allowed them to raise up to $50 million and essentially create these online REITs, these online funds, to then go and deploy the capital. But what it really did was it eliminated the fact that it was no longer targeted toward accredited investors. It could be anybody and much lower minimums. Now, today we're seeing people going back to the 506C offering model, which Arbor Crowd only does 506C offerings. We never went to the Reg A Plus model because we felt that that was the model that had the most stability in it and was going to be there throughout the market. And that's what the SEC was ultimately going to look at and say, you know, we approve of this and the way it's being done. So I'm going to talk a little bit later about why companies have moved to the Reg A Plus, but really moving back to that 506C model, which I think is very important for both investors and sponsors, people who are looking to raise money on platforms, to understand the nuances and the difference that those models offer, and ultimately the security and the risk that each of the models have to offer, and why people are turning back to 506C. You know, when you look online beyond those two models, the fund model versus direct to investment on a deal by deal level, you'll see debt and equity. Now, as a lot of people listening know, that debt is a legal instrument. Debt has a lot of nuances that require an enormous amount of expertise to operate within those nuances and fully understand them. The debt industry is heavily regulated and often requires a lot of licensing, right? And that's because it needs to be done correctly and needs to be understood correctly. So when you're asking from a retail perspective to have people understand not the asset themselves, but the underlying debt concept, it's harder for people to get to that mental grasp. They can't say, oh, my name is at the bottom of that building and I have ownership. Well, they may feel more secure that there's more steady yet lower returns. To really do that successfully requires an enormous amount of expertise, and investors at the end of the day have to do more work to understand that concept as a whole. So you have the expertise on the sponsorship side that you're relying on and hoping that they bring to the table, and the expertise on the investor side, really understanding what they're investing in and what they're securitizing. And we know from the Arbor family of companies in business, and Arbor Realty Trust being a publicly traded REIT that's licensed Fannie and Freddie lender, just what those nuances are. And we're seeing a lot of the debt platforms out there who don't know what those nuances are, offering that up to their investors. That could pose a lot of trouble in the future when some of these deals and these hold periods come to fruition and go south. So we think what's great about equity is you can track the dollars down to the property level, and an investor can go home at night and say to their family and friends at the dinner table, I own a piece of real estate, just like they can say, my name is at the base of the Statue of Liberty, right? The equity model is much easier to understand, and this is, it always, I will repeat this, it always matters what site you're working with, and the experience and the presentation and transparency that they offer you to make sure that that equity investment is safe and secure and you can feel comfortable with it. From the sponsor's perspective, you really don't want to go crowdfund your debt. You want to go crowdfund your equity because you don't want to end up in a class action lawsuit with a bunch of investors who didn't really understand the instruments behind debt when they were making that investment at the time, but rather you're getting that passive non-interfering equity, right, to help you close on that transaction that can be traced down to the property level. Now, there's a lot of different methods of investing in real estate. Obviously, now the newest method is this crowdfunding method. And this really comes down to what you as an investor are comfortable with and what you are willing to do. So with crowdfunding equity, you are passively investing in a property, right, alongside a sponsor, hopefully. So there's a alignment of interest there, where people have a lower barrier to entry because they can do the process entirely online. But more importantly, if they were doing it with the right company, they're looking at the offering overview and presentation of the deal being presented to them online with the same details that the actual sponsor is looking at himself or herself to make that investment, to do it online. So the access is easy, and then they're passive, so they don't have to worry about the day-to-day operations on the property level because you're partnering with sponsors who do that day-to-day, who have that expertise, and you're getting comfortable with that level of expertise. And that's a preference. That's a type of passive investing that a lot of investors on the retail side are happy doing. Now you have online REITs and private REITs. The online obviously have lower barriers to entry, but again, you have to align with the strategy that REIT is taking, or the private REIT that they're working with, right? To get on board. You don't get to see the investments at a property level the same way you do, and therefore you're subject to the business plans and or the transparency levels of the REITs that you're working with. With private REITs, you obviously have to be in the know, and you're insulated from the market volatility, so you have to really feel comfortable with the leaders of those companies and what they're reporting out to you. The public REITs, the good thing is you have the security of the public market. The bad thing is that you're subject to the ups and downs of the public market. You can make those investments, and they are liquid, which is great, but you have to, again, align with the business strategy that those REITs are presenting. Then you have private equity funds, which have a very high barrier to entry and a very high minimum requirement. So if you're looking to take $25,000 investments, get started. It's hard to do that when the barriers to entries are sometimes $250,000 or $500,000. You also have to know the private equity funds to get involved with, to be in the know, and trust their business plan as well. Now, direct ownership kind of falls outside of that because that's really a career change. You're basically turning into a real estate owner and operator on a real estate level. I'll jump in, Dave. Dave, I know you have a lot to say here, so maybe you want to jump in with some of your thoughts.
Yeah, I think that really the point about having individual asset exposure is really important. And you've probably heard the news recently about single asset REIT IPOs potentially hitting the market, but now due to market conditions, that's not going to happen. And so to your point, Adam, one of the primary advantages here is that this is one of the only ways you can have direct exposure to a single asset if you so choose, without having to buy the whole asset or be part of a larger syndicate with potentially a larger ticket to get into that. So with this, it's a bite-sized chunk, and it's one particular asset if you want to sharpshoot the market.
Now, to add to what Dave is saying, it really matters the most in understanding who you're partnering with. What are the platforms that you're trying to invest with through crowdfunding? What are they presenting to you? Do they have that depth of experience? Are they just a technology company? If you're going to them to try and raise equity from their investors, right? Are they doing the right diligence? Are they presenting to their investors the right materials that you feel are safe and secure, that you'll never have an issue in the future, right? So track record is really important. And the way Arbor Crowd works particularly is we make sure that our sponsors have skin in the game, so that everything that they're doing is aligned with the investors on the passive side, because they have money in the deal as well. Actually, in our last transaction, even the construction company invested in the deal. So on the property level, on what was happening on the day-to-day was so important because the interest was there. There was a mutual alignment and people felt comfortable. And we were able to present that track record in the offering overview to investors to show that, hey, they know what they're doing and they have a good expertise in doing that. So when you're going when you're going to a crowdfunding site to raise money, you have to be prepared to share that information, that track record, and you have to be prepared to put your dollars on the line to get real good investors and to attract them in the right way. Because you don't want to have your deal go live on a platform and not get any interest and ultimately not be able to close on a transaction, have to change the way or lose the transaction really because you didn't present it the right way or the company didn't share with you how to present it the right way. So it's important that both sides understand how important the track record is to be shown and how important it is for interest to be aligned. So when you're evaluating deals, right, you'll see a lot of people are familiar with crowdfunding or real estate, I should say, and they know what they're looking at. The market's really IRR driven. People are looking at different, they're looking, am I getting a 15 to 20% projected here? Am I getting in the 20s? Is it ground up? It's really important to know it's not just about the IRR, that flashy number. It's not about that. And everybody has different preferences. It's about that trust and security and knowing that the operator is going to be there doing their job and knowing that the operator is there with a successful track record, with money on the line as well. So take into effect a lot of the different things going on, and that should all be presented to you very, very clearly in the offering overviews that crowdfunding platforms are presenting you with. Now, when you speak to the different types of investments and the different types of opportunities, and we're going to turn to asset classes in a minute, because Dave has a lot to say about it there too, you have to think of your own preferences. You have to think of, can my money be tied up for a long period of time, and I don't see that much cash flow here, but I understand, at the end of the day, I'm going to make a good amount on the sale of the property, and I believe in the strategy being implemented by the sponsor. So the sponsor has to be prepared to show and share their strategy with the investors to have that alignment. So it's different. Some investors, they like cash flow on day one, and they want to see money coming into their accounts quarterly or when there's distributions more regularly. Others, different investment profiles where they're okay with their money tied up. And that's really, you have to say, how am I trying to diversify my portfolio and what am I looking to do for my specific investment needs? And with that, I think we should turn a little bit to asset class here. Arbor, our focus right now is on multifamily. But Dave, why don't you share some of your thoughts on the asset classes being presented today in the market?
Yeah, if you really think about what's happening with things like with rising home prices, what's really happening is that more and more people are getting priced out of the housing market. And at the same time, we actually have pretty strong job growth. And so people are doing okay, but they're having to work multiple jobs, for example, and they're having to really stretch their budgets as much as possible. And so property types like workforce housing are actually experiencing a boom for two reasons. One is because they're a little less expensive and there's job growth in the service sector, which tends to pay a little bit less. And at the same time, if you think about the development cycle, we continue to see new supply being added, but it's all being added at the top. And so when we're looking at different property types, some of the best performing assets today are workforce housing that's really focused on providing housing for the needs of people working in, say, service industries that aren't necessarily high paying. And those opportunities exist throughout the country. There's some specific regions that are doing well, but there's really opportunity throughout the country, and I could speak more about that in some detail.
Yeah, I think even to add to that, it's, you're seeing a lot going on in the stock market and the volatility there. And right now, from Arbor Crowd's perspective, we're starting to see a lot of investors turn to commercial real estate investing. And our focus is multifamily. Our focus is workforce housing, because ultimately we feel that's a really secure, safe space for a retail investor to come in and learn and get familiar with. But at the same time, you have to know where the real estate market cycle is right now. Everybody knows that the real estate market is performing really strongly and everyone wants to get in on it. But what that means is that there's not that much supply because people are paying a lot of money to get in. Less experienced people are getting in on the market, paying a lot of money, capitalizing on it being good right now. But their all-in cost basis is not really going to prove to show good returns in the end of the day. And that's why when you're getting into the real estate market, you have to really say to yourself, did they underwrite the deal? What were the mechanisms they put in place to really say these returns are real, they're not bloated, and that they are, and I can expect to have real expectations and make some money here in the deal. And the IRRs are representing themselves pretty significantly or pretty appropriately, I should say. So there are a lot of people out there. I know we see deals that go up on platforms that we passed on. So you really want to know on the diligence that each of the different platforms are doing on the deal to provide that to investors, and that's important.
Yeah, and I think in terms of cycle, Adam, to your point, it's a good one because, as most people know, we are several years into this cycle, and we have seen, in particular in multifamily, a little bit of deceleration in rent growth in the last year. But it's very interesting. If you look at workforce housing rents are growing about 2% faster than average rents are in the U.S. And it's interesting, there's another story here, which is that in a lot of the cities where you have high job growth, you have, of course, related to that, a high need for workforce housing. And so in some of the markets, particularly in, say, Florida or in the desert Southwest, you're seeing rent growth not only do better because it's workforce housing, but it's also doing outperforming because the population growth in some of those areas is so substantial. So there's really opportunity in a number of different markets right now, even this late in the cycle. And I think that your point about workforce housing in particular being durable throughout cycles is correct, because people continue to have jobs and a need for housing, and there's really nowhere for them to go other than some of these more value-priced multifamily units.
I think for people who are listening on the line saying, how do I become a sponsor? How do I raise crowd equity for the deal? It's important that you focus on workforce housing, because that's what's going to stand steadier throughout when the market does hit its down point. And it's important because you want investors who continually come back and invest. You want happy investors at the end of the day. So workforce housing again is a really stable and steady place to be. I will also say there's good deals in the market's up, there's good deals in the market's down. It's about who paying the right price for those deals and having the right strategy of execution and finding them and underwriting them with the right due diligence. And you want to make sure that the platforms that have those mechanisms in place for protective rights. So now if we turn a little bit to some of the transactions, just to kind of talk more about what Arbor Crowd does. We focus on multifamily. These are 3 examples of the deals that we've done. The deal size for us is not as important. What's important is the check size that we'll write, and we know our investor base, and we know, what their interests and preferences are. We know it very intimately. So when you're going to a crowdfunding platform, you want to make sure that if you're a sponsor, one, they can close on day one with the equity up front so that you don't risk losing the deal, because nobody wants that risk up in the air. And that requires, the platform actually knowing their body of investors and what their preferences are. So we know the mix of our investor base. We know what their preferences if they're willing to hold on to a longer period of time with less cash flow, more cash flow, shorter period of time. If they're looking for more of a value add strategy, rehab strategy versus a ground up. And that's where we focus on within the workforce housing space, because obviously we feel that demand is constant there, especially with rent growth rising and with people renting more now than ever and buying less overall. So, have your expectations in the correct place when you're going to work with a crowdfunding company to say, okay, can they really write this check for me? And do they know their investor base to do so? Because you really want to make sure that you're closing on it. So here's a few examples where we raised anywhere between $2 and $6 million for a transaction. We've done actually 6 transactions to date. We've raised almost $20 million from our crowd investors within pretty much a year's period of time. And we focus on the quality of the deal before we launch it. So if we don't have we don't feel there's a good deal, we're not going to post on the site, and we may not have a live deal for a given period of time. So again, it's really about knowing our investors and what we can fund. Dave, if we go back actually one slide, Dave, I'm not sure if you want to add anything specifically to, for sponsors potentially listening and understanding the demand here of why multi in these areas.
Yeah, I think multi in those areas, and I think that those deals in particular, Adam, highlight kind of one of your key advantages that you were talking about earlier, which is that you have exposure to deal flow because you're looking at loans, you're constantly looking at equity deals as well. And I think that's a really important part of the process, this volume of deals, so that you're really cherry picking the assets that are most attractive to you. That's a very important part of your system. And you can see in these particular cases that these, for the most part, are workforce housing types of opportunities where there's probably a value add component. And really, the way to think about that is, in real estate, there's a lot of high-end fancy real estate around. But if you just drive through most cities, there's a lot of real estate that's a little bit undermanaged, and that's really a key part of this investment opportunity. Is that sometimes when you're looking at a bunch of deals, you'll run across assets that are a little bit undermanaged, maybe they're a little underinvested in, and there's an opportunity for some pretty generous IRRs. Yeah,
I think generous and realistic. So it's a combination of both. Mm-hmm. Absolutely. These deals, just to give you guys some context, 1413 New York, that transaction, we were able to raise in 7 days. That's how we build our network of trust with our investors. And that's because we're really tied to Arbor family companies, and they understand the depth that we have in the space to really have done the right due diligence and been in line with the guidelines, which we know well and we've invested a lot in. And our investors understand that and they feel part of it, and that's why they jump in and invest so quickly.
Speaking of the time it took to raise the money, and David, you were talking a little bit about the investment climate. I wondered if both of you could comment on the investment climate right now for workforce multifamily, how competitive it is, how quickly the deals are turning over as a result. What is the potential investor facing?
I'll start and I'll let David get in more detail, but basically, you know, it's hard to find quality deals right now, and people are overpaying like crazy for those deals, and it's not competitive. And at the end of the day, the returns are not going to be that great. And what's happening right now is we're seeing the deals that we've passed on other crowdfunded platforms that are having investors invest, and by the time the deal's life cycle comes to fruition and the crowd investors face a significant amount of disappointment because of the lack of experience that those sponsors are participating in the market, there's going to be a lot of problems, and the SEC is probably going to take some action and stepping in to give investors those protective rights. And that's what we're seeing on the crowdfunding side. I'll let Dave jump in and kind of add his thoughts.
I think that's a very important point, Adam. And for those of our audience who have followed the history of crowdfunding for other asset classes as well, you know about some of the platforms and some of the startup challenges there. And so having a solid platform with lots of basic commercial real estate deal experience is extremely important and a critical part of what I think Arbor has to offer. In terms of the current environment, I think everyone's looking at their trading screens every day and interest rates and the stock market and all of that and saying, what's really going on here? And I think on the whole, it's pretty clear that things have decelerated, which kind of sounds like negative news. But honestly, in the transaction environment, it's probably a little bit of a relief, because transaction pressure, to Adam's point, is probably softening a little bit. And hopefully some of that money that's overpaying for assets, to Adam's point, will maybe not be quite so ebullient. And so I actually think that we're setting up for an environment over the next year, 18 months, where there are going to be more opportunities because some of the less sophisticated purchasers are going to back away from the table a little bit. So I think it's actually the environment is improving, even though right now we're in a little bit of a lull.
Yeah, and to add on that, for what we do at Arbor Crowd is we have these relationships with sponsors that we've worked with for many, many years, and we are doing the financing on their projects. So we have this access to this base of people who have successfully done this and know what they're doing, and know how to find good deals. Some are off-market deals that we have access to. That's very rare because of our tie to the Arbor family of companies. So, you know, we feel confident in our deal selection because of the track record that we have and the relationships that we have with these sponsors. We're doing the financing on the same project. Sometimes our private equity shop is coming in as part of the equity, and the crowd is coming in as the other part of the equity. So we're really hitting it at all sides, and we feel confident in this strategy and secure, and our investors do too.
Adam, New York is a pretty safe market to invest in, but I know you've done investments elsewhere in the country. I think there was one recent one in Alabama, in fact, if I remember correctly. Could you talk about where else you're looking and what you're seeing in these different markets?
Yes, so it goes back to the fact that our last deal actually in Alabama, the sponsor on that deal, Trace McCreary, has a lot of experience in Alabama. And we had 2 projects with him actually in the area. So we understand his experience. We've underwritten and done the due diligence on it on many of his past transactions. And we said, okay, we feel that his business plan matches what we're seeing on the market data side, right? And we're doing all of our reading all our reports and saying, you know what, he knows this, he has an in, he feels very intimate with the area, he understands where things are trading so well, and we're backing that up just, you know, with basic data that we're getting and pulling out of access to in our databases with all of our transactions and deals. So again, it's about choosing the right sponsor who knows how to execute in the area on a good business plan. And that's what we do differently, and that's what we have to make sure that other people are doing too. If you're looking at New York, we're a New York-based company. Our fund, AMAC, actually was in the 1413 New York Avenue transaction. Their experience is in this workforce housing. They do a lot in Harlem, they do a lot in Yorkville, they do a lot in Brooklyn. This is what they do, right? And we're syncing up retail investors and crowd investors with what our sponsors do best in their local areas. So it's about who's doing it and where.
And David, I think you're making reference a little earlier to some other markets where you saw investment opportunity, and maybe it would be a good time to revisit some of what you had mentioned and anything else you'd like to add about opportunity markets around the country.
Yeah, it's very interesting. If you look at kind of the life cycle of where the U.S. population is, we all hear about the aging of the population, but just to throw out a few data points, the average baby boomer is turning 63 years old this year, and this is right about the time when boomers start thinking about moving for retirement. And so if you look at the migration patterns around the United States, to Adam's point about doing deals in Alabama and other areas of the South, we're seeing towns in Alabama, for example, just booming. Huntsville, Alabama, for example, Mobile area are doing extremely well, because what's happening is people are leaving some of the northern climates in retirement and moving to Florida, the South. They're also moving to the desert Southwest. And so if you look at rents nationally, some of the fastest rents in the country are in Las Vegas, Phoenix, as people come out of California for retirement. And what's happening in conjunction with that is then the job growth follows, in particular service jobs in healthcare and leisure and entertainment. And so there's a tremendous need for housing in those markets, as well as Florida, as you can imagine, being a no-tax state. That area is just booming. So, and in addition to some of the other areas, parts of Dallas and Atlanta are seeing rent growth that is 2-3% on average higher than the average in the United States. So it's, to Adam's point, it's really, the key is really a local sponsor, and within that, having a strategy that fits with what's happening in the broader macroeconomy. And a lot of that relates to these migrations driven by baby boomers, for example.
Absolutely. For Mobile, particularly in Mobile, Alabama, there just isn't workforce housing there. And you're seeing so many companies, two particular companies that we go into detail in our business plan and present to investors, that are looking to hire north of 7,000 people in the local area, and there just isn't the supply to meet the demand that's coming in. And you have these baby boomers coming in who are willing, they're not looking to buy, they're looking to rent. They're willing to spend $50 extra just for, basic appliance upgrades in their apartments, right? And you have these owner operators, if they can exist, because downtown Mobile doesn't have much going on there, that they're in dire need of development, who they don't know, they don't have the expertise. They've been there for, maybe owned the building for 50, 60 years. They don't have the expertise, and they're looking to get it off our hands. And we're talking about just basic upgrades to the apartments that really, really will achieve significant growth and returns.
Yeah, it's very interesting, looking at commercial real estate markets, and people always talk about primary markets versus secondary and tertiary markets. And I'll just kind of emphasize that there continues to be a lot of opportunity in some of these smaller cities, because there's a lot of opportunity in the big cities. There's so much opportunity in the big cities that sometimes the commercial real estate professionals just don't make it to some of these new opportunities. But this is clearly where a lot of the new opportunity is. And to your point, Adam, the infrastructure to this point just simply doesn't exist. And there are a lot of new residents down there that have more than enough cash to pay a little bit extra.
We actually went in, Trace actually went into our last deal, the one that closed in 5 days. It went so quickly. And he spoke to the residents in the interview and said, would you pay $50 for a washer dryer more a month in your unit? And they were saying, yes, please, we'd like that. We'd love that. So even having sponsors who are getting that feedback and understand that their tenant base will support it is very important when you're making an investment decision, to support the numbers there. So yeah, absolutely. that different mentality developing.
You know, one of the things that I think about that's interesting is if you look at the REITs and you examine them by property type, some of the best performing REITs are the manufactured housing REITs. And it's because of this very type of demand that people are looking for reasonably priced housing. And in a lot of cases, it may not be in the best location, but they're willing to pay up for it. And if you look at the yields, they're some of the highest yields in all of real estate.
It's amazing. It really is. And just to finish up before we turn to questions, I want to just iterate what the Arbor Crowd difference is and why we do things the way we do, and why you should look, if you're looking across all other crowdfunding platforms, making sure that you are presented correctly and you are given the best information. So, you know, quality of the deals obviously relates directly with the experience of the sponsors. We have relationships through the Arbor Realty Trust side that date back many years and through multiple market cycles. Don't forget, real estate, the cycle always changes. It goes up and down no matter what. So how have they survived the different cycles? And, you know, workforce housing, for example, is the most safe and secure asset class in evolving cycles up and down. We take on the risk. So we front the equity up front on day one. We close on transactions. Then we take on the raise from our investors ourselves. That's the pride we take in knowing where our investors' preferences are. That at the end of the day, if the raise falls short and the onus is on us to fill the rest of the capital that's committed to the deal already, we don't think we'll be there and we haven't had to, thank God, because we know our investor base so well. So on day one, the deal closes and the sponsor does not have to worry about the crowd raise. We do that. We facilitate all those relationships. You're not going to get calls. You do a webinar with us and you provide us with your information that we can present to the crowd, and the diligence that we do, we present to the crowd as well, so that really it is an easy check up front if the deal makes sense. As an investor, you want to make sure there's no hidden fees. You don't want to have to read through over 100 pages of a PPM, a private placement memorandum, to find out that there's a fee here and a fee there. There's a sliding scale of fees that's presented in a black hole later on down the road. You want to know what the fee is to get into the deal up front, and that should be presented to you very clearly within the offering overview, not buried anywhere, and there should not be sliding scales. Education is something that we take pride in. We are constantly sending investors articles on the different terminology of real estate. Real estate, you don't have to be a genius to be in real estate. What you have to do is know the lingo. So we are constantly putting a lot of effort into giving investors the understanding of the different language involved, how it's working, how they can interpret it to make decisions on their own. And ultimately that translates into the offering overviews that we present to our investors with, that has the same information that we use to analyze the deal into 30 pages for the investor to make that investment decision. So, you know, we feel confident in that, and that's what really you should be looking for if you're going to another crowd platform or crowd site to make an investment.
Well, thanks so much for your insightful discussion, Adam and David. We'd now like to open up the floor for your questions, and we'll answer as many as we can today, and if we aren't able to address yours, we'll be sure to follow up separately. To start off, Adam, I'd like to ask if you could provide us with a review of the life cycle of a crowdfunding deal. Just take us through how the process works up until what's an investor's exit strategy.
So, you know, the process in selecting a deal is very important. So like I said, we have basically added to our menu item for our borrowers who come to Arbor Realty Trust this new method of getting passive, non-interfering equity. Why do they want it? Because our borrowers always need a little bit of equity. They don't want to have to syndicate or take on that responsibility themselves, maybe from family and friends. It's a new method for them. And additionally, they can either participate in more deals or larger transaction size deals without having to do a lot of work, because we raise that money up front. Now, what goes into it is we first underwrite it from the debt side, where we're doing the financing on all the deals that we're involved with. That requires the rigorous expertise and diligence that Arbor Realty Trust has in motion for many years as a licensed Fannie and Freddie lending platform. And, you know, we do a lot of balance sheet lending as well. So that level of diligence and experience is very important. Once it passes that hoop, we then take it over to our side of the house, where we say, okay, we're going to look at it from an equity perspective. Does this deal make sense on an IRR level? what's the budget, what's the renovation plan, what's the strategy, what's the experience of the sponsor, how well does he know or she know the area, what strategies have they implemented successfully in the past. That's very important. And we underwrite it through our own lens and determine whether it's good for the crowd. And we aim, depending on different markets, in the mid-teen IRRs return to high teens. If it's New York City primary, a little lower, but we look for that safety, that security. We close on that. We say to the borrower that had come to us originally through our Realty Trust, say, we'll write you this check up front. So in this past deal, we wrote $2.6 million. Sometimes we do 3, 4, depending on the size of the deal, obviously. So they say, great, we can go and close on that deal. Then we go to the crowd. We put together the offering overview, the materials that we need to show investors that, hey, here's how we looked at the deal to make sure it was a good deal and it worked. So this is how we've made it digestible for investors. We are here to answer all questions on the phone. We do webinars, marketing, promos, all types of ways that investors can come and understand it. We even provide drone footage of the property so the investors can get a platform. We let investors come and do property site visits whenever they want. We organize those for them to get a look and a feel so that they really feel part of that ownership structure. And ultimately, if they may decide to invest, they can and feel confident that the deal is going to go through because we put the money down front. If we ever fall short, the onus is on us. But we believe in the deal so much to take on that risk. So that's kind of the life cycle of how the platform works and a deal gets to the investor level.
So a question from our audience: how can mortgage brokers participate with Arbor on this platform?
Absolutely. So if you don't already have a relationship with Arbor Realty Trust as a mortgage broker, you can reach out to me. And basically what I can do is I can align you with the other side of the shop. And you can market to your clients. We'll give you some basic understandings of and materials to present to your clients who are looking for more equity, and we can work out that relationship. We have materials that we provide to a lot of different mortgage brokers we've done in the past, so feel free to reach out to me and we can set up calls and have those conversations.
Can the sponsor get direct contact with investors?
We do, what we do is the sponsors don't want to talk to the investors. They don't want to deal with the 90 investors coming in at $25,000 clips, because Arbor's minimum investment, Arbor Crowd's minimum investment in our transaction is $25,000. There are a lot of questions. You wouldn't believe it. We have an entire team that answers questions and facilitates this. So the questions are coming in. We handle all of that. The sponsor just participates on a webinar and gives access on a property level, and we leave it at that.
Okay. Going back to the types of properties that you invest in, are you looking at value-add Class B and C? What kind of properties are you looking at?
So we are looking at multi-value-add Class B and C. We do rehab. We look at rehab properties as well, and management plays. Inexperienced managers and bringing management efficiency. So that's a great question. Somebody's asking, what's the time span between a crowdfunding campaign and an actual funding? Mm-hmm. So I think what you're asking is, if when we put our money down up front, right, and to close on a transaction, how long does it take us to raise the money? Some of our deals have gone as quickly as 3 business days, where we've raised over $2 million. Some take 30 business days, where we're raising larger deal amounts. And ultimately, it doesn't really matter that much how long the deal takes, because we put the money on front and our money's on the line. But usually it doesn't take more than 30 business days.
This question says, is there a necessity of the sponsor participating with equity in the deal?
That's one of our core tenets in how we present crowd investors with investment opportunities. It's really important for a passive investor to feel like their interest is aligned with the sponsor who's running the property. And in doing so, we require that sponsors have equity in the deal themselves, that we actually market that amount out to the crowd so they feel confident that the interests are aligned there.
Are you currently limited to workforce multifamily? Are you looking at other property types like, say, retail or suburban office?
We would look at suburban office. Right now, we're not, where the market is, we're not particularly looking at retail or hospitality, but we look at suburban office and self-storage.
Does Arbor Crowd have a deal proposal format that it wants to use?
I think that's a marketing question. Yeah, I mean, we have a method down that we use, but we're always evolving.
Okay, can you talk about the criteria you look at when taking on new sponsors?
First and foremost, what is your experience? Have you survived the market cycle in '08? We want to date back between 5 and 10 years of experience to show the breadth and scope of realized and unrealized investments that you have, because that is what is presented to the crowd and people will need to buy into. So that is an important criteria, and that you can put your own equity in as well.
Okay, we have a question maybe David could speak on. You talked about the multifamily before, David, and can you talk a little bit, since Adam was talking about some of the other property types, about where you see the commercial real estate market heading?
Yeah, absolutely. And I think that Adam's guidance is a good place to start with kind of the pause in retail. I think that if you listen to some of the commentary coming from the retail sector a year ago or so, people were saying, well, it's softening a little bit, but it's going to be okay. And I think the concern has elevated a little bit in the past several months. And so I think that there's a little bit of concern about retail and how that's going to be positioned. And the biggest question is going to be, what does it really cost to redevelop some of these assets to their new the new generation of uses? So I think there's a lot of concern about retail. I think that the central business district office environment in some cities is oversupplied, and so we're seeing some rent flattening out there, and there's a little bit of risk there. So I think that's why, if you think about suburban office, there's really an opportunity, because a lot of suburban office is older assets where you could spend a little bit of money and attract a new tenant and at higher rents. And in the suburbs, while they're not necessarily growing as quickly as some of the city centers, there are some very desirable suburbs, and there's some undermanaged assets. So there's an opportunity there for sure. In self-storage, it's very interesting. It's something that I've spent a lot of time on the last couple of years, and it's one of the best performing asset classes. And in general, people think of self-storage as kind of following some of the economics of the multifamily sector, which is true. And if you fine-tune it a little bit more, you can see that actually the self-storage industry is lining up with what we're seeing in the aging of the population that I was speaking to earlier, which is that you have a lot of boomers with a lot of stuff, and they may be leaving Los Angeles, selling their $1 million house in Los Angeles and moving to Phoenix and buying, say, a $300,000 house and pocketing the difference and living off of some of that. And they're going to need a place to store their stuff. And so if you look at self-storage, the performance in recent years has been faster rent growth by 2, 3, even 4% per year relative to multifamily. So there continues to be an opportunity in self-storage. And if you read the press on storage, you'll hear that there's a lot of new supply. And that is true in some of the markets, but there's only a half a dozen markets in the United States where the new supply of self-storage is really all that heavy. In most markets, self-storage rents are still holding up well. And in some parts of the country, as I mentioned, in the desert and in Florida, self-storage rents are doing even better than multifamily is. So that's a fantastic area.
You know, we just started to look at a bunch of self-storage units, and we're really excited to get one onto the platform, because we agree with you, your analysis completely, and feel that self-storage is a lot like multi, and it's a great opportunity to present retail investors with.
Yeah, self-storage is interesting because it's almost by definition the cheapest house in the nicest neighborhood. These are often kind of unique parcels, but they're in good high traffic areas. And so if you think about it from a commercial real estate perspective, there's some of the best commercial real estate plays because there's so much potential for upside pressure in pricing over the years.
We have another question from the audience. Can brokers get compensated for bringing equity investors?
Yes, so Arbor Crowd, we are not a broker-dealer. We don't license a broker-dealer, but we can arrange pricing structures that do make sense. Maybe we can get very creative in pricing structures and make it work. So absolutely reach out to us, and we can get on a call and talk about how to make that work.
And can you clarify how you guarantee that a deal gets financed?
So first and foremost, like I was talking about the process before, right? If you come in through Arbor Realty Trust and you go through the rigors of determining whether you qualify for financing, you then come through to the Arbor Crowd side to see if it makes sense from an equity perspective to present to the crowd based on your experience, your background, and how you market, and also if the IRRs are high enough and good enough for where we feel our investors would jump into. And because we do that, if it's successful and we feel that will be successful, we write a check up front so the deal closes. So we write whatever we're going to raise in the crowd, we write into the equity check, the deal closes, and then we go do the raise. So the deal is closed before we go out to the raise.
Okay. Along those lines, can you please talk about projected and actual IRRs for investors?
So yeah, since we've launched, we project IRRs in different areas based on our underwriting. We'll project anywhere in the mid-teens to high teens. If it's like New York City, for example, it'll be low to mid-teens. Obviously, it's its primary market. So that's how we determine the projection of our IRRs. Obviously, we're a newer company. A lot of the deals, the hold periods that we have are 3 to 5. So we haven't disposed of any entire investment opportunities. We did dispose very early of one of the properties that's in a portfolio, and there is a significant amount of return on the invested capital, and our investors were really happy to see that.
Do you invest in ground-up projects?
So ground up is we haven't done a ground up yet. We're actually looking at a ground up potentially in Mobile. But we feel that there are longer project holds and investors get really sucked into high IRRs with ground up, and it requires a certain expertise and it lacks the same fundamental security that we're trying to promote in the stability of the instability of where the market is right now. We will always consider ground up and we look at a lot, but it really has to fit well. And obviously there's a lot that goes into ground up, right? So we have to make sure that the experience extends beyond just the sponsor all the way through, the construction and leasing. So yeah.
Just to confirm, can you really complete the process entirely online?
Yes, that is a question that people ask all the time. I've had investors complete the process entirely online in under an hour. And that really depends on how much due diligence you want to do and read into the process. But everything from submitting your offer to signing the subscription documents is done online, and you wire your funds in with banking instructions online. So we make it easy, and if you need help along the way, you call us and we'll facilitate that help and walk you through it. A lot of our investors are less savvier with computers right now, but it's not that complicated. And once we walk them through it really quickly, they get really excited and they come back and repeat and again and again their investments with us.
Do you have any plans for debt crowdfunding?
We don't. As I said before, first of all, we have our Realty Trust, which is the debt financing side of the family of companies. But again, it's all about, will the retail investor invest in debt? And we think that it's a step removed from ownership of property, and as a legal instrument, it requires a more nuanced understanding. And really, we're focusing on the equity side, and we think that's where the longevity is in the market.
Okay. So once you become a qualified sponsor, another question from the audience, how much time do you need to evaluate a deal that's submitted to you?
It can be as quick as 3 days and up to a week, depending on how much material is presented to us and how much diligence, or how much reports are there, and how organized the sponsor is, and we can get it quickly done in 2-3 days to a week. So, how much does Arbor Crowd charge for raising equity? So we are a fee-based business. We charge our investors fees Standard real estate fees, we do an acquisition fee of about 1%. Sometimes it varies a little bit up, a little bit down, depending on the strength of the deal. We do a refi fee. We do a disposition fee of 1% and an asset under management fee of 0.5 point. So we present that very clearly in the offering overview. That's how we make money, and that is charged to the investor. But I must say, the investor, to guarantee their security, gets paid their money back when they invest before the promote kicks in and the sponsor starts seeing any upside on the deal.
Well, we're out of time today, but thanks again for attending, and thank you, David and Adam, both, for your information and your observations. We hope you found this informative, and we'll be sending you a link to the recording so that you can review the information you heard today at your leisure.
Thank you. Thanks for having us. Thanks, Dave, too.